Good evening, students. Welcome to the session. I hope you have revised the last class. So, what we have done in the last class, I'll just quickly recap. We had finished section 56 to 10. We had done deemed dividend taxability, which was under 222A to 222E. We had seen that. And then we had seen 56 to 7B, which was from the perspective of the consideration received, which is greater than the issue price. In that case, the FMV minus consideration is considered as the income of the issuing company, which is the closely held company, right? And then we had started with the clubbing provision. So what we are going to do today, if you remember, we had done some part of the clubbing provision. Now we would be completing it, and then we would be moving to set off and carry forward. And then we would start with the deductions chapter if the time permits. Otherwise, we'll do it in the next class. Okay. So let's get quickly started with it. Okay. So see, we had done under the clubbing of income. If the first we had done what is the if the asset is transferred, but the if the income is transferred, but the asset is not transferred, then there will be clubbing under section 60. Then we had seen what is revocable transfer of asset if there is the power to reassume, or if there is a provision for retransfer of income or assets, it is considered as revocable. It will be not considered as revocable if there is transfer to the trust, which is not revocable during the lifetime of beneficiary, or transfer not revocable during the lifetime of the transferee. But the transfer should not derive any benefit. If the transfer derives any benefit, it would be considered as revocable transfer. Then remuneration of spouse from a concern in which individual has substantial interest, meaning greater than equal to 20% voting power or right on the profits over more than 20%. Then it will be clubbed in the hands of the individual. It is not applicable if the spouse possesses technical or professional qualification. And if both the spouses are partners in the same particular firm, then in that case, the spouse whose income is higher, and in that particular individual's hand, the other person's income will be clubbed. Then income from transferred asset to spouse in connection with the agreement to live apart, or with the adequate consideration, then in that particular case it will be not clubbed, right? Then in the case where there is agreement to live apart for the house property, then it is considered as the deemed owner under section 27, right? If it is from the agreement to live apart, then it is not considered as deemed owner. But if it is in relation to the house property, then in that particular case, it will be considered as the transferor is the deemed owner, and then the annual value will be taxed in the hands of the transferor. Okay. Here you can just mention that exceptions. Give me a minute. Yeah. Right. And here you can write assets, house property, other asset. Then 6417, which is in respect of transfer to any other person for the benefit of spouse. Let's say I've transferred it to the trust for the benefit of spouse, then that will be clubbed in the hands of the individual only. Now moving further, now this was in respect of the spouse. Next is the clubbing of income arising to the son's wife. Clubbing of income arising to the son's wife. Okay, so if the asset is transferred without the adequate consideration, again it will be clubbed in the hands of the transferor. So this is 6416. Asset transferred without adequate consideration. At the time of the transferer, at the time of the transfer, that particular individual should be the wife of his son. It should not be the case that at the time of the transfer, the son is only engaged. If the son is only engaged, then there is no relationship which is subsisting at the time of transfer, and therefore the clubbing provision would not be attracted. Okay. So asset transferred without adequate consideration to the son's wife, then the income is to be clubbed. If the asset transferred is invested in the business, let's say the same thing we did for the spouse also, if the spouse or the son's wife invest the assets transferred into the business, then the proportionate income arising from such investment is to be clubbed in the total income of the transferor. If it is in the nature of the capital contribution, then the proportionate interest from the firm will be clubbed in the hands of the transferor. Are we clear? So you can maybe just write it down. You can write down for both. Asset transferred, invested in business or as capital, proportionate interest to be clubbed. Proportionate interest to be clubbed. This is applicable for both, right? Then, are we clear? Then transfer of assets for the benefit of the son's wife to any other person. Like what we did it here, transfer to any other person for the benefit of spouse. Similarly, under 64(1)(8), asset transferred to any person for benefit of spouse. Let's say I've transferred the asset to a trust for the benefit of the spouse, then for the son's wife, not spouse, sorry. Then it will be clubbed in the hands of the transferor. Son's wife. Are we clear? Also, at the same time, understand one thing. The person who is receiving the property without any adequate consideration, in the hands of that person also, the income will be clubbed. So income, sorry, in the hands of that person also 56(2)(10) will be applicable. So 56(2)(10) applicable in the hands of recipient if the transfer is for inadequate consideration. So for the recipient, there will be 56(2)(10) applicability. For the transferor, there will be the clubbing provision, which will be applicable in this particular case. Are we clear? Right? Are we clear? Any doubt? So 56(2)(10) will be attracted in the hands of the recipient, right? 56(2)(10) should be attracted in the hands of the recipient. Then third one is clubbing of minor's income. Clubbing of minor's income. So all the income of the minor is to be included in the income of parents, except in a case where the income is derived by the minor from the manual work or from any activity involving his skill, talent, or specialized knowledge, that will not be included in the income of his parent. So clubbing of the minor's income always, except income from manual work or specialized skill, or the specialized skill or talent, that will not be included. Let's say if the minor kid is earning from, say there is singing competition which is being there. So then in that particular case, if he has won there, that will be the income of the minor and not that of his parents, right? Now, in which parent's hand this particular income should be clubbed? So the clubbing has to be done in either of the parents' heads, right? It's not necessarily that it has to be clubbed in one of the parents or in the hands of the mother or in the hands of the father. But once clubbing of minor income is done with the one parent, then it will continue to be clubbed with that parent only. Then in 1 year, you cannot say that it will be clubbed with the mother. In the second year, you will say it will be clubbed with the father. So once you've decided that the minor's income is to be clubbed in the hands of mother, it will be continue in her hands only in the subsequent years also, even though her income may increase in the subsequent year. It should not be the case. Then you will say that you have to club it in the hands of the father. Are we clear? Where the marriage of the parents is not subsisting, then the income of the minor will be clubbed in the hands of the parent who maintains the minor children, okay, or the minor child. So if marriage of parents not subsist, does not subsist, then income to be clubbed in hands of parents, in the hands of the parent maintaining the minor. Clear? Also, if the minor is disabled, then you will also give the deduction under ATU, right? So in case the income of the minor is there, but the minor suffers from any disability which is mentioned under ATU section, then that shall not be included in the hands of the parent, but shall be assessed in the hands of the minor only. Okay, so in case the income of the minor suffers from from a minor who is suffering any disability under section ATU, the income will not be clubbed in the hands of the parent, but that shall be assessed separately. So that will also come in exception. Minor suffering from disability specified in section ATU. Are we clear? Then the clubbing provisions are also attracted even in respect of minor married daughter. So even if the daughter is married, but she is a minor daughter, then in that case, the clubbing provisions will still be attracted. So you can write it down. Attracted even for minor married daughter. Clear? Also in the case of the clubbing, when the income of the minor is clubbed, then section 64(1)(a), in that case, the clubbing will be performed. Now, there is an exemption which is given under 1032 that the parent shall be entitled to the exemption of 1500 rupees in respect of each minor child. So, there will be the exemption of rupees 1500 per minor child under section 1032 in the hands of the parent. Are we clear? Are we clear? Again, here, in case the asset is the house, in case the asset is a house property, then the transferor parent will be deemed to be the owner of the house property, and the annual value of the house property will be charged in the hands of the transferor. So in the case where the asset is a house, then 64(1)(a) would not be attracted, but it would be considered as the deemed owner. Are we clear? So this is 64(1)(a). If the asset transferred is house, parent, or you can write transferor parent, is the deemed owner and annual value charged in hands of transferor. Are we clear? Now here, since this is going to be assessed under section 27, right? This is under section 27. Therefore, your 1032 exemption will not be applicable. Also, this is not applicable to a minor married daughter. So minor married daughter is excluded from 27. Though she is included in 64, but here in case the house property is transferred to a minor married daughter without consideration, then section 27(1) is not attracted. So that income will not be included in the hands of the parent. Are we clear? So if the house property is transferred by the parent to his minor married daughter, then 27(1) is not attracted, meaning the transferor parent will not be considered as the owner of the house property or deemed owner of the house property. However, in that case, 64(1)(a) can still apply. 64(1)(a) can still apply, though 27(1) will not be applicable. However, in that case, we may still be able to apply the 64(1)(a), whereby the income from the house property will be included in the hands of the parent, and exemption under 1032 can also be availed in that particular case. Are we clear? So in that case, 64(1)(a) can still apply. Are we clear? Are we clear? So you can just make a small chart for this. Clubbing of minor's income, other asset, house. House is in section, or you can write it down. Maybe we can further categorize it. Minor son, minor daughter. Again, further categorize married, unmarried. Minor son, transferor, deemed owner. NAV taxed. Minor married daughter and minor unmarried daughter, 27(1) Not applicable. (27)(1), not applicable. Minor marriage, sorry, not for unmarried. (27)(1), not applicable. (64)(1)(a), applicable. For unmarried, again, (27)(1), applicable. Are we clear? Then here you can also write down 1032 exemption, not applicable. Then in case of the other asset, minor son, minor daughter, married as well as unmarried, right? In both these cases, 64(1)(a) is applicable. Income to be clubbed in hands of parent having higher income. Once clubbed, it will always be clubbed in hands of that parent. Marriage does not subsist, then in the hands of parent who maintains. But what will not be clubbed is excludes income from manual work or skill performance and if disability under section 80U. Then exemption under section 1032 of rupees 1500 per child. Okay, the income will be clubbed in the hands of the parent whose income is higher without including this income, right? Are we clear? Any doubt? Clear? Now, child in relation to an individual also includes a stepchild and an adopted child. So, step as well as adopted child is included over here. Here you can write down step plus adopted. Are we clear? So see, when you're revising for your examination day, you can maybe only refer this particular notes or these pointers so that you may not go through the entire chapter when you're revising. And this will save a lot of your time. See, some of the chapters you have to do it very quickly in like 10-15 minutes. So then in that case, I would suggest you to just make the pointers and read it from there instead of reading the entire chapter. Okay. If husband of minor married is transferring house property to minor married, then it is to transfer to the spouse. And then again, it will be clubbed in the hands of the parent. Vinay. Clear? Okay. Now, last one is the cross transfers. The cross transfers now. Also, one last thing before we, close this thing, the clubbing provision. Understand one thing, that income also includes a loss. So explanation 2 to section 64 provides that the income would also include loss. Accordingly, where there is a loss also, that loss will also be clubbed. That loss will also be clubbed. So maybe you can just write it at the start itself. Clubbing of income. So income includes the loss. Clear? Income includes the loss. Also, in case where the income is clubbed, right? But whether there would be liability in respect of the person to whom the income or the asset is transferred, yes. So the notice of demand may also be served upon the person to whom the asset is transferred. In that case, the transferee is liable to pay the tax levied on the transferor, which is attributable to the income so clubbed. Similarly, it is the case even where the house property is transferred. So let's say there is a person who has gifted the house property to his wife and his married daughter. The assessing officer can serve the notice of demand on the transferor. He can also serve the notice of demand on the wife for the payment of the tax, which is on the income derived from that share of house property transferred to her. And he can also serve the notice on the transferor also. Are we clear? Clear? Any doubt? Any questions? Okay. Any doubt? Any questions? Okay. The last one then is cross transfer. Now, this is not a provision under the Act, but this has been a tax planning strategy which have been used, and the Supreme Court judgment has clarified on this regard. So let's say there is Mr. A and there is Mr. B. Okay. Now, Mr. A, if he would transfer, let's say, the income to Mrs. A, right? Then there would have been the clubbing. Even Mr. B, when he transfers the income to Mrs. B, or let's say minor son of B, there would be clubbing. Correct? So what they do is they devise a strategy by which, let's say, A will make a gift. A will make a gift. So instead of doing it like this, A will make a gift to the minor son of B. Right? A will make a gift to the minor son of B, and simultaneously, let's say he gives the house property, or let's say he gives the cash. And let's say now Mr. B will also gift to Mrs. A, let's say, shares. Let's say he gives the shares to Mrs. A of the equivalent amount. So in this case, the income from the assets transferred would be assessed in the hands of the deemed transfer, because the transfers are intimately connected. The transfers in this case are intimately connected and this is a circuitous method. This is a circuitous method. The transactions are interconnected and are part of the same transaction. So these transfers are intimately connected in a way that it can be said that this is a circuitous method to avoid tax. So what will happen in this case? The income arising to the minor son from the, let's say, house property would be included in the total income of B. So let's say if instead of cash here gives house property, then the income from house property will be clubbed in the hands of Mr. B. Similarly, the dividend from the shares transferred to Mrs. A would be taxable in the hands of A. So here, dividend will be clubbed. This is as per the Supreme Court ruling in case of Keshavji Morarji. This is as per the Supreme Court ruling on the case of Keshavji Morarji. Are we clear? So this is the meaning of the cross transfer. Clear? Last one thing before we close this particular chapter, conversion of self-acquired property into HUF property. Section 64(2). So if the self-acquired property is converted into the property of the HUF, because the individual member will put such property into the HUF, then in case this particular transfer is otherwise then for adequate consideration, the income from such property will continue to be included in the total income of the individual, even in a case where the property will be partitioned later on and the income is derived from the income is derived by the spouse of that particular individual. Still that income will be clubbed in the hands of the individual only. Are we clear? So if it is for otherwise then for adequate consideration clubbed in transferor. Any doubt? Shall we close this chapter? I'll give you 2 minutes. Yes, when a parent or spouse both under 27. If husbands transfer the house property to the minor married, then it is clubbed in the hands of the transferor. So it will be clubbed in the hands of the husband. If the parent is transferring, then it will be clubbed in the hands of the parent. If the husband is transferring, then it will be clubbed in the hands of the husband. So it is clubbed in the hands of always the transferor. Any other question? Yes, I'm waiting for 2 minutes. If you have any question, we can discuss, else we can move on to the next topic. Okay, no questions? Okay. So let's move on to the next topic, set off and carry forward of the losses. Set off and carry forward of the losses. Okay. Okay. Now, in the set off and carry forward of the losses, understand one thing. There are two things which we need to understand, the interhead and the intrahead, or the intersource and the intrasource set off. Okay. So that is one thing which we are going to discuss first, and then we will go on to discuss the specific loss category under the each head of income. Are we clear? But first we need to understand the basic concept for the set off of the losses. Clear? Okay. Now understand one thing in the context of the set off of the losses. If you have any brought forward unabsorbed losses, unabsorbed depreciation, if you remember, we have done what is unabsorbed depreciation. Unabsorbed depreciation, if you remember, we had said that it is the depreciation which is not utilized against the income. So in case there is a loss from the business, the portion of the depreciation in that loss is considered as the unabsorbed depreciation. Now that can be carried forward indefinitely. Under section 32(2), it will be considered as the current year depreciation in the next year. And as per the priority of the set off of the losses or the depreciation, if you remember, under section 32, I'll show you. We had seen that. What is the priority of the set off? Give me a minute. See, order of set off. First will be the current year depreciation, then will be the business loss brought forward because it has the time limitation, and then will be the unabsorbed depreciation. So, unabsorbed depreciation you can carry forward and set off indefinitely, and can also be set it off against any other head except for the salaries. Are we clear? So this is for the set off of the losses. Now let's begin with the set off of the losses. As I said, in the set off of the losses, one second, let me change the page. Give me a minute. Why is it not happening? Yes, okay. Now understand one thing very clearly. In case of the set off of losses, we have the section from 70 to 74 onwards. We have section 70 to 74 onwards covering the set off of the losses. Now, section 70 is talking about the source under which one can set it off the losses, right? Or the head of income under which one can set it off the losses. So that's what we have to start with it. So let's start with section 70. Let me just paste it over here. Okay. Are you able to see the screen? Yes or no? I think my PC is just getting hang. Okay. Let me just 1 second. Yeah. Okay. Intersource adjustment section 70. Section 70 is the intersource adjustment. Now, what does section 70 says? The losses incurred by the assessee in respect of one source shall be set off first against the income from any other source under the same head of income. So first you will try to set off business losses against the income from business or profession. Since the income under each head is to be computed by grouping together the net result of the activities which are performed under that head of income. So first, loss from one source can be set off against income from another source, but first you will have to set it off under the same head of income, right? So even if, let's say, I have a textile business loss, I can set it off against the income from the footwear business, as both are my business. As both are my business. Are we clear? Now, there are exceptions to this where the intersource set off is restricted. So, intersource adjustment, you can just write down here. Intersource, you can write it down. Or let me just make it a chart for you. But first, we'll cover section 71. Now, section 71, which is there. Section 71, which is there, is inter-head adjustment. Now, what does it say? Losses from one head can be adjusted or set off against the income under the another head. However, there are again restrictions over that, for which I'm just making a small chart for you so that you will not be, confused, and you will not have to think about under which head what you have to do. Okay. So, first is salaries. There cannot be any loss, right? Under the head salaries, we cannot have any loss. So, we'll start with the income under the head section. Income from house property. You can have losses under the house property, right? Now set off interhead and intersource. First I'll write interhead, intersource, and then interhead. Right? And then the carry forward time limits. Time limit under carry forward. Okay. Now, house property is covered under 71B. We are going to look at it specifically. But whether intersource set-off is permitted, answer is yes. Whether interhead set-off is permitted, the answer is yes. So you can set it off against any other head of income, even against salaries, but up to rupees 2 lakh. But up to rupees 2 lakh. Right? You can set it off against any other head of income, even against the salary, but up to rupees 2 lakhs. So in case of the house property losses which are there, then in that particular case, where the net result of the house property loss is exceeding 2 lakh rupees, then in that case, the amount would not be allowable to be set off against any other head. In other words, the maximum loss from the house property which can be set off against income from any other head is rupees 2 lakhs. So you can set off against all the heads of income, but up to rupees 2 lakh you can set off. So in case it may be confusion, what you can do is you can make this as one bracket and then you can write in the next line. Otherwise, you may think that it is only for the salaries, it is up to 2 lakh. Okay. Up to rupees 2 lakh. Clear? Next is PGBP. Next is PGBP, which is other than the speculation or the specified business loss. Other than the specified business loss or the speculation loss. So PGBP or business loss can be set off against any other head, as well as it can be set off intersource also, but under any other head, not against salary. So except against salary. House property loss can be set off against salaries. Are we clear? Then speculation business loss. Speculation business loss which is there. Speculation business loss. Can it be set off against the income from any other business? The answer to that is no. So speculation business loss can be only set off against the profits from any other speculation business and not against any other business profit. So it is restricted in terms of the intersource set off, only against speculation profit. It can be only set off against the speculation profit. Clear? Can it be set off against any other head of income also? The answer to that is no. It cannot be set off against any other head of income. Are we clear? So, no. It can be only set off against a speculation income. Next is specified. Okay, here you can also start writing the section number. Business loss is 72. Speculation, you can write it down 73. Then specified business loss. Specified business loss meaning the losses arising under the business for which we have claimed the exemption under section 35 AD. Covered under section 35 AD. Now this is 73A. This can also be only set off against specified business income. This can only be set off against specified business income. Again, your interhead is not possible. Clear? Next is capital losses. But before that, unabsorbed depreciation, which is under 32.2. Unabsorbed depreciation. Can it be set off against the business income only? No. Sorry, yes, intersource is permitted against any other head, any other business income, right? Interhead is also permissible. Interhead is also permissible except against salary. So it can be set off against any head of income other than salaries. Clear? Next is 74, short-term capital loss. Short-term capital loss. Now, short-term capital loss can be set off against any source, which is, it can be set off even against the long-term capital gain. Even against the long-term capital gain. And whether it can be set off against any other head of income, the answer to that is no. It can be only set off against the income from capital gains. Then, long-term capital loss. It can be only set off against long-term capital gain, and it cannot be set off against any other head of income. Right? So that is under 74. Then 74A, winnings from losses from the owning and maintaining race horses. Loss from owning and maintaining race horses. Again, that is only permitted against only from income from that activity. And interhead is not permitted. Now, why there is restriction on the set off of the long-term capital loss against the short-term capital income or short-term capital gain? The answer to that is simple. Short-term capital gains are usually taxed at higher rate compared to the long-term capital gain. If you see for listed, we have long-term capital gain taxed at 10%, short-term is 15%. Similarly, in case of other assets, long-term is 20%, short-term is at higher rate, which is a normal rate. So therefore, in order to avoid the tax rate arbitrage, long-term capital loss can only be set off against long-term capital gain and not against the short-term capital loss. And even capital losses cannot be set off against any other head of income. Clear? Any doubt? So losses from the specified business can be set off only against the income from the specified business. However, other business losses can be set off against the specified business loss, specified business income. Similarly, speculation business losses can only be set off against the profits of the speculation business and not against any other business. But if there is any other business loss, that can be adjusted against profits from the speculation business. Clear? Same is the case with the short-term capital loss that can be allowed against short-term or long-term capital gain. However, long-term capital loss can only be set off against the long-term capital gain. Clear? Also, another thing, loss from an exempt source cannot be set off against the taxable profits. So let's say I have the share of loss from a partnership firm that cannot be set off against the other business income. Since the income is exempt, the losses will also be considered as exempt. Are we clear? So you can just make a point over here. Losses from exempt source cannot be set off against taxable income. Are we clear? Cannot be set off because the income itself is exempt. The losses will also be considered to be exempt. Clear? Are we clear? Okay. Then we are now going towards the specific set off of loss. If first what you will have to do is first you will have to set off against the same head of income, which is the intrahead, or you can here write it down, intrahead or intersource. Here you can also use the term intrahead. So first you will have to set off the loss intrahead under the same head of income. If there is any loss still unutilized, then you can set off against the any other head, right? Now in terms of if the loss is still unutilized, even after setting it off against any other head of income, you will carry forward the loss and set off in the future year, in the coming years, against the same head of income. In the case of the brought forward losses, you cannot change the or you cannot set off the brought forward losses against any other head. Let's say I have the house property loss. Now, first, what I'll do is I will utilize against the income from the house property. Once that is done, if there is still unutilized loss, what I will do is I will set off against the business income. But if there is still unutilized loss, then what I'll do is I'll carry forward to the next year. But in the next year, I cannot set off that brought forward house property loss against any other head of income, against the business, capital gain or salaries. I will have to set off only in that particular head of income. So only in case of the in case there is a house property loss, you can only set it off against the house property income. Same is the case with any other loss, with the PGBP, capital gain or whatever. In the case of the brought forward losses, you cannot set it off against any other head of income. You can do the interhead and intrahead in the current year. In the case of carry forward losses, you cannot do interhead and intrahead. Intrahead and interhead is for the current year, is for the set off of the current year losses. You can write down very specifically here. Okay. So carry forward of losses has to be under same head, under the same head of income. Are we clear? So for the house property loss, if there is a loss under the head house property, such loss will be first set off against the income from the house property, then against the any other head to the extent of rupees 2 lakh. The unabsorbed loss will be carried forward and set off in the future year against the income from house property. What is the maximum period for which it can be carried forward and set off? It is 8 assessment years. So write down what is the time limit. It is 8 AYs. Are we clear? You can write down your head also. Under the head house property, you can only set off. ROI mandatory to set off the losses? Answer is no. The return of income is not mandatory, as in within the time limit, it is not mandatory to file the return of income for the set off of the house property, for the house property loss. Clear? Are we clear? Then in case of the business loss, first you will set off against the same source, whether it is speculation, specified, whatever. Then whatever is remaining, you will set off against any other head except for the salaries. And if there is still unutilized loss, then you can carry forward and set off against the profits of the subsequent years from the business. Right? So you can only set off against the profit from this business only. So it will be under PGBP. And here, the losses should have been incurred in the business only. The losses should have been incurred in the business only. Right? So it is not important that it should be from the same business activity. It can be against any other source of business also, but what is important is that it should have been incurred from the business activity to be carried out. Are we clear? Then what is the maximum period for set off and carry forward of losses? It is 8 years. Again here it is 8 years. It is 8 years. Right? And whether return filing is mandatory? Yes, your return filing, if you have to claim losses, you need to file your return of income before the due date under section 139(1). In case you're not filing a return of income by 139(1) due date, then your losses will lapse. You will not be able to carry forward your losses. Are we clear? Any doubt till now? Are we clear? Any doubt? Okay. Then next is the capital losses. Next is the capital losses. Again, in the case of the capital, the speculation losses. Now, as I said, for the speculation loss, you can only set it off against the speculation profit. And if there is any loss which is unutilized, then you can carry forward and set off against the speculation profit only in the subsequent year. And the maximum period for which you can do is 4 years. So only against speculation profit. Only against the speculation profit. Again here, whether it is mandatory to file the return of income, the answer to that is yes. Within the due date, you have to file the return of income in order to claim the losses. Are we clear? Any doubt? We have seen what is the speculation business when a person is deemed to be carry on the speculation business, where the business of the company consists of sale and purchase of the shares of the other company. Such a company shall be deemed to carry on the speculation business to the extent to which it consists only of the sale and purchase of the shares. However, if the company's business is one of that of where the principal business is business of trading in shares, business of banking, granting of loans and advances, then that will not be considered as speculation. Or where the company's total income that considers majority of the income is from house property, capital gain and income from other sources, then in that case, it will not be considered as the company is engaged in the speculation business. Derivative transactions, futures options, all of that commodity transactions are not considered to be speculation in nature, where you're not taking the delivery. Intraday transactions are considered as speculation, correct? Then specified business loss, as I said, it can be set off only against the specified business income. The unabsorbed loss will be carried forward in the future years. And here also, there is no time limit for carry forward and set off of the specified business losses. But it can be set off only against the specified business income in the future years. Are we clear? So it can be only set off against the profit of another specified business which is claiming the deduction under section 35 AD. Clear? So you can write it down here. Indefinitely only against specified business income. Whether you have to compulsorily file the return of income, the answer to that is yes. In order to claim the losses, you need to file the return of income within the due date of 139(1). Then 32(2), you can again carry forward and set off for any number of years, and you can set off against any other head of income other than the salary in the future year also, because this is considered to be the current year depreciation. So the unabsorbed depreciation is deemed to be the current year depreciation, and in the carry forward also you can set it off against any other head, or let me just write it down, because this is deemed to be the current year depreciation other than salaries. Are we clear? And this can be carried forward indefinitely. Again, for unabsorbed depreciation, is it mandatory to file the return of income under 139(1)? Answer is no. Clear? Short-term capital losses, again, as I said, short-term capital losses can be set off first against the long-term capital gain, short-term capital gain, and the balance, if any, will be carried forward and set off in the future years only against the income from the capital gains and not under any other head of income. And the maximum period for which it can be set off is 8 years. Only for 8 years. Only against the capital gain income. And again, whether the return filing requirement is mandatory, the answer is yes. You need to file the return within 139(1) due date to claim the losses. Clear? Any doubt? Okay. For the long-term capital gain also, it's the same thing. So 8 years only against the capital gain, and return filing is mandatory. Return filing is mandatory, even in that particular case. But long-term capital loss can only be set off in the future year also only against the long-term capital gain and never against the short-term capital gain. Here you can write down short-term or long-term. Even in case of carry forward, long-term capital loss can only be set off against long-term capital gain. For losses from owning and maintaining race horses, that can be carried forward for a period of 4 years and can only be set off against income from the activity. Whether return filing before the due date is mandatory, the answer is yes. The answer is yes. Are we clear? Any doubt? Any question? Any doubt? Okay, very simple. Okay. Now, as I said, for the order of the set off of losses, you can write down order of the set off of losses. You can write down again. I'm just mentioning it. We have already done that, but still. First, the current year depreciation. First, you will set off always the current year depreciation under section 32(1). Then the current year capital expenditure on scientific research, family planning, expense on scientific research and family planning under 35, right? Then the brought forward business loss under section 72(1), then you should set off the unabsorbed depreciation under section 32(2). Then you can set off unabsorbed family planning expense, scientific research expense. Family planning and scientific research expense. First, you can in fact set off scientific research and then family planning. This is also deemed to be the expense of the current year. Scientific research and family planning. Clear? Are we clear? As I said, the return of income is mandatory for the business losses, for the speculation business loss, for the specified business loss, capital gains, and activity of owning and maintaining racehorses. So the assessee should file the return of income before 139(1) in order to claim the carry forward and set off of these losses. If the assessee does not file the return of income within the time limit, if it's a belated return, then you cannot claim these losses. In case of house property, there is no requirement to file the return as per 139(1). Even if you belatedly file it, you can claim the house property loss. Clear? Are we clear? Okay. Now, in terms of the amalgamation and demerger losses, now that's what we are going to do now first. And then we'll take a break after this. Okay. Now understand one thing. We have done this already as well. The carry forward and set off of business loss in case of amalgamation and demerger while we were doing it in capital gains. So, if you remember, I told you that 72(a) talks about this. But now what is the need? Let's try and understand this very clearly. So see, what happens is when we are computing the business losses, usually the principle is that it is the person who carried on the business is entitled to carry forward and set off of the losses. So if I am carrying out the business, I am only entitled to set off and carry forward the losses. That is the basic principle. Right? Now, to provide an exception to this. Why? Because it was a time when in 1990s, India was opening up. The companies were incurring a lot of losses. So in order to give a boost to the economy, in order to give the boost to the public sector undertakings at that time, in order to, enable the government to not get, stuck up by the loss-making company by providing the incentives to them in the form of subsidies, grants, whatever, because otherwise it would have a burden on the government, right? If the government have to bail out these companies. So in order to give the incentive to these companies to get into amalgamation, to turn them from the loss-making to profit-making entities, this exception was introduced under section 72(a), that even if the loss is not incurred by the same person who is carrying it forward, still the carry forward and set off of the loss will be permitted. So carry forward and set off of the losses incurred by one person will be permitted to be carried forward and set off by the another person in case the conditions are satisfied for the amalgamation or demerger. Are we clear? So what are the conditions? Let's try and understand. So section 72(a) is exception to the rule that one who incur the loss can carry forward. Right? The objective was to incentivize these loss-making units to get amalgamated or demerged so that they can be turned profitable. Now, what are the conditions here? If you remember, we have already done that. We have already done these conditions. Okay. So this applies where there has been an amalgamation of eligible companies. What are the eligible companies? A company owning an industrial undertaking. A company owning industrial undertaking. Hotel. Industrial undertaking. Hotel. Ship. So this is applicable where the company is engaged in the or owning an industrial undertaking or a ship or hotel with another company, a banking company, then public sector companies, then erstwhile public sector company. So a company which was a public sector company in earlier years and now ceases to be a public sector company by way of strategic disinvestment. Air India. This was the amendment which was introduced specifically for Air India. Because if you remember, Air India was a public sector company and now it was taken over by Tata Group. So it ceases to be a public sector company by way of strategic disinvestment. Strategic disinvestment meaning that there has been a sale of shareholding by the government, which results in the reduction of the shareholding to below 51%. Right? Which results in the reduction of its shareholding to below 51%, and there is transfer of control to also to the buyer. So there is a strategic disinvestment of the public sector company, or you can write the erstwhile public sector company. Clear? So if the share purchase agreement entered into under the strategic disinvestment is restricted to the immediate amalgamation of the public sector company, and the amalgamation is also carried out within the 5-year period in which the restriction on the amalgamation in the share purchase agreement ends. Are we clear? So this is specifically which has been introduced for the Air India strategic disinvestment which was undertaken. Clear? Any doubt till now? So these are the companies which are covered under 72A. Any question till now? Any doubt? So for these companies, the accumulated loss and the unabsorbed depreciation of the amalgamating company shall be deemed to be the loss and the unabsorbed depreciation of the amalgamated company. Clear? Now, what is the industrial undertaking? What is the industrial undertaking? Industrial undertaking is also defined, which means the undertaking which is engaged in processing of goods, or manufacture of computer software, sorry, or generation or distribution of electricity, or distribution of electricity, or providing the telecommunication services, telecom services, or mining, or the construction of ship, aircraft, or railway system. Ship, aircraft, or railways. This is the meaning of the industrial undertaking. Meaning only these certain categories of the businesses are allowed. It is not that for all the businesses it is considered. Right? So manufacture or processing of goods, manufacture of the computer software. Sorry, here you can write manufacturing or processing of goods. Business of generation and distribution of electricity, telecom, and construction of ship, aircraft, or railways, and the mining. So it is not there for the service industry if you look at it at the moment. Are we clear? And then the banking company, public sector company, erstwhile public sector company, that is a company which has ceased to be a public sector company by way of the strategic disinvestment. Clear? Are we clear? Any doubt? Any doubt? Okay. So in this particular case, you can write it down. Losses of the, or write down unabsorbed, or let's say this, losses and unabsorbed depreciation of amalgamating company can be carried forward and set off by the amalgamated company. This is the business loss. These are the business losses. Are we clear? So it says that notwithstanding section 72, the accumulated loss and the unabsorbed depreciation of the amalgamating company shall be deemed to be the loss of the amalgamated company, shall be deemed to be the loss or the unabsorbed depreciation of the amalgamated company for the previous year in which amalgamation is effected. So therefore, here, since it is deemed to be the loss of the amalgamated company from the year in which amalgamation take place, the losses can be carried forward and set off by the amalgamated company for fresh period of 8 years and not for the balance period of 8 years. Here you can write down losses and business losses and UAD of amalgamating company. Instead of this, just write down shall be deemed to be loss and UAD of amalgamated company. Clear? So let's say if I have the business loss of previous year 2020-21. Now, let's say I have the amalgamation happening in the month of January 23, right? So in that case, already 3 years have passed out of 8 years when the amalgamation take place. But then in that particular case, I will still be allowed not the balance period of 5 years to the amalgamated company, but again a fresh period of 8 years to the amalgamated company. So in the case of amalgamation, a fresh period of 8 years is allowed to the amalgamated company instead of the balance period which is remaining for the set off of the unutilized losses. Clear? Are we clear? So accumulated business loss and UAD of amalgamated company because it's deemed to be the loss and UAD of the amalgamating company. Clear? Any doubt? Any doubt? Any questions? Any doubt? Okay. Now let's say in case of the amalgamation of the erstwhile public sector company, the accumulated loss and the unabsorbed depreciation of the amalgamating company there also is deemed to be the loss or the unabsorbed depreciation of the amalgamated company, but that shall not be more than the accumulated loss and unabsorbed depreciation of the public sector company as on the date on which the public sector company ceases to be a public sector company as a result of strategic disinvestment. So the total loss which is carried forward and set off by the amalgamated company will not exceed the losses which were there as on the date the public sector company ceases to be a public sector company. Are we clear? So the losses and unabsorbed depreciation of the amalgamating company in case of strategic disinvestment, which is the loss now of the amalgamated company, will not exceed the losses and unabsorbed depreciation as on the date when the public company ceases to be a public sector company. Are we clear? Any doubt? Okay. Now, what are the conditions? So this is an incentive provision and it comes up with the conditions attached to it, right? So what are the conditions? We have discussed that while we were dealing with the 47 exemption in the case of amalgamation. We have already dealt with this condition, but again, I'm writing. So there are the conditions for both amalgamated company and the amalgamating company. What are the conditions? The conditions are that the amalgamating company should have been engaged in the business for 3 years or more. So, remained in business for greater than equal to 3 years. Why is this condition? Because it should not be the case that it's a new company, it has started and then immediately amalgamated. Because one understands that when a person is in the initial stage of the business, there are bound to be the losses for at least initial 3 years. So it should have remained in the business for 3 years. And even after that, if it has not been able to convert itself into a profit-making entity, it can amalgamate. But at least it should be there in the business for 3 years. It should not be in the business for lesser than 3 years because one understands that there are initial losses when one starts a business. Okay. Secondly, the amalgamating company has held continuously as on the date of amalgamation at least 3/4 of the book value of fixed assets which are held by it as on the date of amalgamation for 2 years prior to the date of amalgamation. Now, why is this condition? Because it should not be a case that the company does not have any assets. It is just a sham company which has just the losses, right? So at least for the period of 2 years, it should hold the 3/4 of the book value of the fixed assets, which it holds as on the date of the amalgamation. So holds 3/4 of the book value of assets continuously for 2 years. Are we clear? Then what are the conditions to be fulfilled by the amalgamated company? The condition is that the amalgamated company should also hold at least 3/4 of the book value of the fixed assets of the amalgamating company for a minimum period of 5 years from the date of amalgamation. So, holds, you can write down, holds 3/4 of the book value of assets of amalgamating company for 5 years. Meaning, it should not happen that it is just buying in the losses, but then restructuring the business by selling off all the assets and making itself a new company. Because the incentive is not given for that. The incentive is given so that you revive the loss-making company. Clear? The amalgamated company continues the business of the amalgamating company for 5 years. Continues business of amalgamating company for 5 years. Because it should not happen that it has just taken the loss, set off the loss and closed the company. Clear? Then the amalgamated company should achieve at least 50% of the production level, shall achieve the level of production which is at least 50% of the installed capacity before, which was there before the end of the 4 years from the date of amalgamation, and continue to maintain the level of the production till the end of 5 years. So achieve 50% of the installed capacity of production which was before the end of 4 years from date of amalgamation for a period of 5 years. And the last condition is that the amalgamated company should furnish the certificate for this regard to the income tax authority. Clear? And the amalgamating company, these conditions are put up so that the amalgamating company and the amalgamated company both ensure that the business is for so that the amalgamation is for the genuine business purpose, and it is for the revival of the business of the amalgamating company. It is not a sham purpose for which, or for the purpose of only to claim the losses, that these amalgamation activity are done. It should not be that case. Clear? Yes, Raja, the loss can also be claimed in the revised return. Clear? But it should be only a return filed under 139(1). So in case there is non-fulfillment of any of the specified conditions, then the carry forward of loss and the unabsorbed depreciation by the amalgamated company shall lapse, and it will be treated as the income of the amalgamated company in the year of failure to comply with the conditions. So non-fulfillment of conditions, unabsorbed depreciation and loss, income of amalgamated company, year of non-compliance. Are we clear? Okay. Any doubt? Any doubt? Okay. Now, what we'll do is we'll take a small break and then we'll come back. We will talk about the demerger and the other losses which happened during the reorganization. As I said, we've already done that while we were dealing with the capital gain exemption in this regard. And then we will go to section 78 and section 79. And then even this chapter will get over. But I think the chapter will take time to get over, and then we can start maybe one or two small deductions if at all the time permits. Okay, so let's take a small break of 10 minutes and then we get back. Okay. Okay. Okay, students. So what we have done is we have done for the amalgamation. Now, very quickly, I will also tell you about the amalgamation for the banks, for which there is a specific provision under 72AA, which is also more or less similar. So when there is amalgamation of the banking company with another bank under a scheme sanctioned by the central government, or where the new banks are amalgamated as per the scheme of the central bank. So in a government sanction scheme, if there is amalgamation, then the provisions are contained under 72AA, where the accumulated losses and the unabsorbed depreciation of the banking company or the amalgamating banking companies shall be deemed to be the loss of the amalgamated banks, and all the provisions will be similarly applicable. Now, what is the accumulated loss? As I said, the accumulated loss is the loss of the business or profession and not the speculation losses. These are not the speculation losses, right? So these are the losses which are other than the speculation losses, which can be carried forward by the amalgamated company, even in this particular case. Then in case of the cooperative banks, in case of the cooperative bank, the provision which is applicable is under 72AB. And again, there are the same conditions therein, that the company should have been engaged, the amalgamating bank should have been engaged in the banking business for 3 years or more, which is what you also see for the normal company also, that it should have remained in the business for 3 years, and then it should have held at least 3/4 of the book value of the fixed assets for last 2 prior years. And the amalgamated banking company, cooperative bank, should also hold the asset, 3/4 value of the asset, for a period of 5 years. It should remain in the business of banking for a period of 5 years. Then in that case, the amount of the unabsorbed accumulated loss and unabsorbed depreciation will be allowed to the resulting cooperative bank. Clear? Are we clear? This is also applicable in case there is a demerger of the part of the cooperative bank, and it is also applicable in case of the amalgamation. Clear? Are we clear? Any doubt? Any questions? Any doubt? Any questions till now? Okay. In case these conditions are not fulfilled, then as I said, it will be deemed to be the income of the amalgamated company. Now let's move towards the demerger. Again, for the demerger, we have already done this when we were dealing with the capital gain. Okay. So you can just make a small note, 72AA for the banks and 72AB for the cooperative banks. Next is for the demerger, which is again under section 72A only. But in the case of demerger, what it has been provided is that if the accumulated loss and the unabsorbed depreciation of the undertaking which is demerged, which is transferred to the resulting company, will be allowed to be carried forward and set off by the resulting company. So, set off of accumulated loss and unabsorbed depreciation of the result of the undertaking or of the demerged undertaking by the resulting company. If the loss is the total business loss, which cannot be directly relatable to the undertaking, there could be a loss of the undertaking, there could be the generic loss of the business also, which may not be directly relatable to the undertaking, then the same will be apportioned between the demerged company and the resulting company in the proportion of the value of assets retained by the demerged company and by the resulting company. So if this is in the case of if loss is relatable to the undertaking. demerged. Right? If the loss is not directly relatable to demerged undertaking, then apportion the loss in proportion of assets retained. In the proportion of the assets retained by the, or the value of assets retained by the demerged and the resulting company. In the case of demerger, there are no conditions specified as we had it in the case of amalgamation. The only condition is that it should be for the genuine business purpose. Okay. Next is in case of the carry forward and set off of the accumulated losses and unabsorbed depreciation in the case of succession. So where a firm is succeeded by a company, where a firm is converted to a company, or a sole proprietary concern is converted to a company, right? A firm or LLP is converted to a company. What we have seen, that there is exemption under 4713, or if the sole proprietary converts itself to a company, there is exemption under 4714. Then in that case also the accumulated loss and unabsorbed depreciation of the partnership firm or the sole proprietary concern will be deemed to be the loss or depreciation of the successor company from the previous year in which the business reorganization takes place. Clear? Okay. Also in the case of demerger, here you are not allowed a fresh period of 8 years. Here you are allowed only the remaining period for set off. Because there is a difference in the language used under the Act. If you see under 72A for the amalgamation, the language used was that the losses of the amalgamating company will be deemed to be the loss of the amalgamated company. Meaning now it will be the loss of the amalgamated company and a fresh period of 8 years will be allowed. Whereas in the case of the demerger, the language is not used in this particular manner. What is the language used in the case of the demerger? It says that notwithstanding anything contained in the other provision of the Act, in case of the demerger, the accumulated loss and the allowance for the unabsorbed depreciation of the demerged company shall be allowed to be carried forward and set off by the resulting company. So what they are saying is that it will be allowed to be carried forward and set off by the resulting company. Here, in the amalgamation, they are saying is that it will be deemed to be the loss of the amalgamated company from the year in which amalgamation takes place, meaning a fresh period is allowed. Here, what they are saying that the resulting company will only be allowed to carry forward and set off the losses of the demerged undertaking. Clear? In case of conversion of partnership firm or LLP or sole proprietary concern to company, then losses of predecessor firm or sole proprietary concern will be deemed to be losses of company. Meaning here again fresh period of 8 years is allowed because the language is similar. Right? What is the condition over here? Condition is comply with condition under section 47(13) and 47(14). But if the compliance is not made, if any of the conditions laid down in 47(13) and 47(14) are not complied with, then the losses and depreciation will be deemed to be the income of the company in which the conditions, in the year in which conditions are not complied. Right? So what were the conditions for the LLP and firm conversion or sole proprietary conversion? There were conditions which were there under 47(13) and 47(14). What were those conditions? If you remember, we have done these conditions very detailed, that the partners should remain safe. They should not get anything other than the share in the company, and more than 50% of the interest remain, shareholders or the partners remain the same, right? So all of this we have done that, correct? So therefore, in that particular case, these conditions what we have done are to be satisfied. Otherwise, the losses will not be allowed. Clear? Okay. Otherwise, the losses will not be allowed. Okay. So non-compliance, losses and unabsorbed depreciation deemed to be income of company. Deemed to be the income of the company. Clear? Similarly, in case of the conversion of company into LLP, conversion of company into LLP, where the exemption was given under section 47(13)(b. Again, here the where the private company or unlisted company is succeeded by the LLP, then the successor LLP would be allowed to carry forward and set off the losses and unabsorbed depreciation of the predecessor company. Okay, so the LLP, which is succeeding the company, then the accumulated loss of the and unabsorbed depreciation of the predecessor company shall be deemed to be the loss or depreciation of the LLP. So again, a fresh period will be allowed. So losses and unabsorbed depreciation of company deemed to be loss of LLP, meaning fresh period of 8 years is allowed. Are we clear? Fresh period of 8 years. In case the entity fails to fulfill the conditions of 47(13)(b, then it will be deemed to be the income of the LLP in the year in which the conditions are not fulfilled. Okay. Non-compliance of conditions, then losses and unabsorbed depreciation deemed to be the income of the LLP. Clear? Any questions? Any questions? Any doubt? Any doubt? Any doubt? Any questions? Raja, it is only in respect to the business loss other than the speculation loss, meaning the specified business losses will also be covered. Clear? So under 72A, the accumulated losses are defined, which means that the losses other than the speculation business losses. So accumulated losses means the loss of the firm or the proprietary concern or the private company or unlisted public company before conversion into LLP, or the amalgamating company or demerged company under the head PGBP other than the speculation business loss, meaning it also covers the specified business loss. So 72A will also apply to the specified business loss. Clear, Raja? Okay. Now we are left with section 78 and section 79. So first we will deal with section 79 and then we will come to section 78 because we are already on 72A. So first I'll deal with section 79 and then section 78 and then one case law and then we'll be done with this chapter as well. Okay. So what is section 79? Now, section 79, which is there, is an anti-abuse rule, is a specific anti-abuse regulation, meaning a SAR. Okay, now what does it provide? Let's try and understand. Now, this is very, very, very important section. So, section 79 provides that so that the carry forward and set off of the losses is not abused, section 79 has been brought into picture. Right? So see 72A, which is there, that has its own set of conditions. That has its own set of conditions for the compliance. For amalgamation, there are conditions for the amalgamating company, amalgamated company. For the conversion, there are also conditions attached to it under 4713, 4714, and for 4713B, right? So amalgamation also has its inbuilt condition attached. But in case of the other than that, in order to prevent the buy-in of the loss-making company, the section 79 has been introduced. So what does section 79 provides? Section 79 is very simple in terms of what it provides is, it says that the persons who beneficially hold the shares, in case of a company, it says that the person who beneficially hold the shares carrying not less than 51% of the voting power should also continue to hold the shares in the year of the incurrence of loss as well as in the year when the losses are set off. So what it just says is that the person or the shareholders holding not less than or more than 51% of the voting power should remain the same in the previous year in which loss is incurred and in the previous year in which the loss is set off. Very simple. So section 79 is very simple in what it says. So section 79 says that for the other companies, it says that shareholders who are beneficially holding not less than, or we can write then, greater than equal to 51% of voting power should hold as on the previous year in which loss is incurred and previous year in which loss is set off. So very simple condition. So in the year when the losses are carried forward and set off, and the year in which the loss was incurred, the shareholders, as on the last day of the previous year, who are carrying not less than 51% of the voting power, should hold the shares in both these years. Very, very simple. Right? So let's say, for example, if let's say losses carried forward and set off, just like it here. So a simple example for this will be, let's say there is a company ABC, or let's say ABCD Limited. There's this company, right? The shares are held by all the four ABCD equally. Now, let's say there are losses in assessment year 15-16, assessment year 16-17, and 17-18. I'm taking 3 assessment years. Okay. Now my business loss is, let's say, nil. It's, let's say, 9 lakh is, let's say, again, or let's take it nil and 9 lakh. Right? I have unabsorbed depreciation of, let's say, 15 lakh, 12 lakh, and 9 lakh. Right? Now, during the previous year, seventeen, 18, A sold the shares to Y. A sold the shares to Y, and during the previous year, 18-19, B sold shares to Z. B sold shares to Z. Okay. Now, let's say the profits for previous year 17-18 were rupees 18 lakh, or let's say rupees 18 lakh before depreciation of rupees 9 lakh, and for previous year 18-19 were rupees 45 lakh before depreciation of 7 lakh 50. Right? So in this case, if you see, now we have 3 previous years. We have 3 previous years and 3 assessment years over here. Okay. Or let me do it like this. So previous year, 14-15, 15-16, 16-17, 17-18, and 18-19. Now, what is the shareholding? A, B, C, D, X, and Y. Now, these are the shareholders. Okay. Now, if I see in the percentage terms, 25, 25, 25, and 25% were held by ABCD. In 15-16, if you see, again the shareholding was same, which is 25, 25, 25, and 25. In the previous year, 16-17, right? In the previous year, 16-17, again my shareholding was same, right? Again my shareholding during the previous year, 16 and 17, my shareholding was same, right? So again it is 25, 25, 25, and 25, correct? Now only in the year 17-18, A sold shares to Y. So my shareholding become like this. Right? My shareholding becomes like this. So since the shareholders holding at least 51% of the voting power are same in the, if you see the losses, now losses are not there in this particular year. In 14-15, there are no losses, so there is no impact. 16-17, there are no losses. Again, in 15-16, there are no losses. There is no impact. When are the losses there? In 17-18, which is the previous year, 16-17. Right? And when those are set off in the 17-18. When those are set off in the 17-18. So in the previous year, 79 will not apply to unabsorbed depreciation. Correct? So the shareholders holding at least 51% of the voting power are same in 2016, in 2016-17 and 17-18. The restriction imposed by 79 will not be applicable. Restriction imposed by section 79 will not be applicable, and therefore for this particular year, for 17-18, what you will do is section 79 is not applicable. Correct? So your business losses will be set off. So 18 lakh was my income, minus 9 lakh was my depreciation, minus 9 lakh my business loss will be allowed. So it will be 0. Right? Unabsorbed depreciation of the earlier year can be carried forward even to the next year. Are we clear? Unabsorbed depreciation can be carried forward to the next year. Very clear? Okay. Now, in the next year, 18-19, even B sold the shares. So, this will be 25, 25, 25, and 25. Correct? Now, if you see, B has also sold the shares. Now, what was remaining of 17-18 was the unabsorbed depreciation. That can be carried forward to the next assessment year. There is no brought forward business loss. And therefore, 79 will not be applicable to the unabsorbed depreciation. So, for next year also, there is 45 lakh business income. There will be 7.5 lakh depreciation. And there will be unabsorbed depreciation of the earlier years, 15 lakh, 12 lakh, 9 lakh, that will be set it off and the taxable income will be computed. Let's say, for example, if instead of 18 lakh, this would have been, let's say, 15 lakhs. This would have been, let's say, 15 lakh. Then what would have happened? Then I would have 15 lakhs minus 9 lakh, which is 6 lakh, and minus, I will have to restrict the brought forward losses only to 6 lakh. So carry forward of rupees 3 lakh. Then in that case, section 79 would have triggered and would have not let me set off the 3 lakh because the shareholding in the year of 2016-17 is not 51% of the shareholders in 16-17 are not same as 18-19 in which the losses are set off. Are we clear? Any questions, any doubt in respect of this? Did you understand? Right? Section 79, is it very clear? So it only says that the shareholders holding 51% or more remain the same in the year of set off and in the year of incurrence of the loss. Clear? Now in the case where these restrictions will not be applicable, there is an exception to this. And what are the exceptions? Exception to section 79, where section 79 is not applicable. So where there is a change in the shareholding on the death of the shareholder. Change in the shareholding or voting power. You can write change in the voting power and shareholding due to death of shareholder. If there is death of the shareholder or transfer of shares by gift to any relative of the shareholder, gift of shares to the relative of shareholder, in case where the shareholding is changing of the Indian company, which is a subsidiary of the foreign company as a result of amalgamation or demerger of the foreign company. If you remember, there was exemption under 47. So if there is change in the shareholding Indian co changes due to amalgamation or demerger of the foreign company, provided that the 51% of the shareholders of the amalgamating or demerged company continue to be the shareholders of the amalgamated or resulting foreign company. So at least 51%. At least 1 second. At least 51% of the shareholders of amalgamating or demerged FCO should remain shareholders of amalgamated or resulting FCO. Of resulting FCO. Clear? Then the next condition is that the 79 which is there will not be invoked in a case where the shareholding change takes place due to the plan approved under the IBC. Resolution plan approved under the Insolvency and Bankruptcy Code, or the change in the shareholding takes place because the tribunal on the application of the central government has suspended the board of directors, and the change in the shareholding takes place pursuant to the resolution approved by tribunal. So resolution approved by NCLT, right? National Company Law Tribunal, where the change in the shareholding takes place on account of relocation of the capital asset by the original fund to the resulting fund. From original fund to resulting fund. And finally, because of the strategic disinvestment of the erstwhile public sector undertaking due to strategic disinvestment. This is so that the Tatas can carry forward the losses of the Air India, because if you remember, Air India was a loss-making undertaking. So the loss incurred in any previous year prior to the strategic disinvestment shall be carried forward and set off by the undertaking which was prior a public sector company. However, this relaxation will cease to apply from the previous year in which the company that was the ultimate holding company of the erstwhile public sector company immediately after completion of the strategic disinvestment ceases to hold 51% of the voting power of the erstwhile public sector company. So when the ultimate shareholding company will cease to hold 51% of the voting power, then this relaxation will not apply. So the relaxation not applicable when ultimate holding company ceases to hold 51% of the voting power. Are we clear? So this is the amendment which has been introduced over here. This is the amendment which has been introduced over here. So be very careful about this particular thing. Here there is an amendment which has been made. So section 79 is not applicable in case where the strategic disinvestment takes place. But that relaxation is applicable only up to the point when the ultimate holding company ceases to exist. At that point, this particular relaxation will not be any more applicable. Are we clear? Clear? So, as I said, the non-applicability is in a case where there is death of the shareholder, gift to the relative because of the plan approved under IBC, demerger or amalgamation of one foreign company with another foreign company, provided 51% shareholders continue there, because of which there is change in the shareholding of the resulting company, change in the shareholding on account of relocation of capital asset by the original fund to the resulting fund. Clear? Now this is, if you remember, what did I say is for the other companies. This is for the other companies, section 79. In case of these startups, in case of the eligible startups, this particular point is applicable in a different way. Or you can write it down, eligible startups. Now, what is an eligible startup? Which is incorporated from the period 1/4/2016 to 31st March 2023. Incorporated between 1/4/2016 to 31st March 23. Next is turnover less than equal to rupees 100 crores. Let's see if in this budget they extend the period of the startup, and holds registration certificate of startup. Right? So this is the eligible startup. Startup should be engaged in the business of innovation or improvement, development, employment, scalable model. Right? Now, if it is a case of the startup, then what is the condition? The condition is not of 51%. There is no 51% condition then in that particular case. The condition is that the eligible startup which is claiming exemption under 80 IAC on the last day of the previous year in which the loss is incurred and in the previous year in which the loss is to be set off, all the shareholders of the company remain the same. So what does it say is that in case of a company, any loss which is incurred in the year, which is allowed to be carried forward and set off, can be done if, as on the last day of the previous year, the shareholders who are holding not less than 51% of the voting power in which the loss was incurred, all those shareholders continue to hold the shares on the last day of the previous year in which the loss is to be set off. So all the shareholders of the company who hold the shares on the last day of the previous year in which loss was incurred continue to hold the shares on the last day of the previous year in which loss is to be set off, meaning there is no 51% condition over here. So either you have to satisfy 51% condition or you satisfy the all the shareholders condition. So all the shareholders as on the last day of previous year in which loss is incurred continue to hold as on the last day of previous year in which loss is set off. Meaning, even if there is change in the shareholding with more than 51%, if there is change in the shareholding more than 51%, still it will not have any impact because the shareholders holding the voting power is not relevant over here. What is relevant over here is that the shareholders who were there as on the last day of the previous year in which the loss is incurred continue to hold the shares as on the previous year in which the loss is to be set off. Are we clear? So that is the condition which is applicable over here. Any doubt? Any questions? Any doubt? Any questions? Any doubt? Any doubt? Yes or no? Are we clear about 79? As I said, section 79 is very, very, very important. Right? Section 79 is extremely important. So if you have any questions, you can ask me now. Yes, very good question, Raja, whether 72A will override section 79. Now, this is very, very important thing and for which there are both the views possible. So see, practically 72A starts with the notwithstanding clause. Even if you look at section 79, that also starts with the notwithstanding clause. So then, which one is to be followed? Which one is to be followed? Whether you follow 79 or you follow 72A. Now, if you see 79 says notwithstanding anything contained in this chapter. Whereas 72A says that notwithstanding contained in any other provisions of this act. So 72A is overriding even 79. 79 is overriding this chapter. 72A is overriding every other provisions in this act. Number one, 72A is more specific provision.
So it will override the general provision. Number 3, more logical answer. Why 72A will override section 79? Meaning, in case there is amalgamation, because of which there is change in shareholding, 79 will not get triggered. The reason for that. What does 72A says? That it will be deemed to be the loss of the amalgamated company. It will be deemed to be the loss of amalgamated company. Now, if I say that it will be deemed to be the loss of the amalgamated company, meaning it says from the previous year in which the amalgamation was effected, meaning it is saying whatever is done in the past, whatever the losses were there of the amalgamating company, do not look at it. From the previous year in which amalgamation is effected, from this day onwards, it is the loss of the amalgamated company. And that is why we are allowing a fresh period of 8 years and not the balance period. Right? So meaning, for applicability of 79, for applicability of the 79, there should have been the change in the shareholding on the previous year in which the loss was incurred and the previous year in which loss is set off. But in case of amalgamation, what we are saying is that you forget what happened in the past. From the year in which amalgamation is effected, it is the loss of the amalgamated company. So for the amalgamated company, in the year of the incurrence of loss, it was not in existence. The amalgamated company's loss is counted from the year in which the amalgamation takes place. Before that, it was not in existence. Before that, it was not the loss of amalgamated company. So therefore, there is no question of 79 applicability. Are we clear? That is a more logical answer. But I also gave you the reasoning. SAR meaning Jacob, specific anti-avoidance regulation. SAR means specific anti-avoidance regulation. Clear? Any other question? Any other doubt? Any other question? Okay. Yes, in case of change in the shareholding, for the non-startup, it is 51%. For the startup, there is, you can either satisfy 51% condition, or the better condition, the more liberal condition is that all the shareholders, as on the last day of the previous year in which the loss is incurred, remain the same as on the previous year in which the loss is set off. Are we clear? Clear? Okay. So as I said, 79 for the startup company, what should be the case is that it should be an eligible startup referred to in ATIC. Such loss, okay, there's one more condition which I have not written over here. You can write it down. Eligible startups, you can write here under section ATIC. The loss should be incurred within 7 years. The loss should have been incurred within 7 years from the incorporation. Then all the shareholders of the company who held the shares carrying voting power on the last day of the year in which loss is incurred continue to hold those shares as on the last day of the previous in which loss is carried forward and set off. Therefore, even if the shareholding falls below 51% during the year of set off, still the loss shall be carried forward if all the shareholders who hold the shares as on the last day in which loss is incurred remain the same in which the loss is set off. So the shareholders should remain the same. Are we clear? So the only condition here is that the shareholders should remain the same. Clear? Any doubt? Okay. Yes, Raja, very good question. I think you've done all this practically. So in case where the startup issues the fresh shares and then the dilution happens, let's say I am a startup where I have the shareholding of A, B, C, D. Okay. Now, in case there is the shareholding of A, B, C, D, Raja's question is very, very good, right? So let's say, let me give you an example what he's trying to say. This is a startup. Now, A, B, and C are the shareholders, or let's say D, 25, 25, 25, and 25. Okay. Let's say in the previous year, 1819, when there was loss. In the previous year, 1920, the loss is to be set off, and there is a increase in the shareholding. The startup raises the new capital. Now, even the X comes into picture and Y comes into picture, right? So what happens is, let's say A and B have reduced their, or all of the shareholders have now reduced their shareholding. So now instead of the A, B, C, D holding, now there will be A, B, C, D, X, Y. So if you see now, the 100% of the shareholding is now held by 5 shareholders, which is coming to 2020. Okay. Right. So if you see, as on the previous year in which the shareholders were there, it was A, B, C, D. Here it is A, B, C, D and X, Y. So what is the shareholding of A, B, C, D? This was 100%. Now also how much is there? 80%, right? Let's say in previous year, 2020, 21, this is reduced to 5%. This is reduced to 5%. This is also reduced to 5 and 5. Right? So in all, this is 20% and this goes to 40%. But here, the previous year 18-19 losses can still be carried forward and set off, and 79 will not be applicable even if the shareholding has fallen below 51%, because the shareholders ABCD remain the same in 18-19 as well as in 2029. So only that is the condition. Clear, Raja? Yes, ESOP shareholders are also taken into account. Why they would not be taken into account? There is no bifurcation of who should be considered in the shareholding or not. Clear? Any doubt? Okay. Now the last provision and one case law, what we have to deal is, last provision is section 78. Carry forward and set off of losses in case of change in the constitution of the firm. Change in the constitution of the firm. Right? So carry forward and set off due to change in the constitution of firm and succession. This is section 78. Okay. Now, where there is a change in the constitution of the firm, then the proportionate loss of the retiring partner or the deceased partner shall not be allowed to be carried forward and set off by the firm. So section 78 provides that where there is change in the constitution of the firm, the loss which is attributable to the share of the retired or deceased partner will not be allowed to be carried forward by the firm. So this is only in relation to the business loss and not in relation to the unabsorbed depreciation. So this restriction, what does it say? Section 72(8) provides that the business loss of, or you can write it down, share of business loss of retiring or deceased partner shall lapse and not allowed to be carried forward by the firm. Clear? Not applicable to unabsorbed depreciation. Not applicable to unabsorbed depreciation. However, where there is succession otherwise by the inheritance, where there is a succession otherwise than by inheritance, where the person carrying on any business has been succeeded by another person otherwise than by inheritance, then such other person will not be allowed to carry forward and set off against the income any loss of the predecessor. Okay. So this is for the change in the constitution. In case there is succession of the firm, section 78 says succession other than by inheritance, loss of predecessor not allowed to successor. The only exception to this is conversion of firm to company. Conversion of firm to company under section 4730. There, the losses of the partnership firm are allowed to the company. So that is an exception to it. In case of succession by inheritance, in case of the succession by inheritance, then in that case, the legal heirs are entitled to set off the business loss of the predecessor. Legal heirs are entitled to set off the losses of the predecessor, even if they constitute their own partnership firm. The firm can also then carry forward and set off the business loss of the predecessor. Okay. So if it is succession by inheritance, successors, individual or firm of legal heirs, firm of legal heirs are allowed to set off and carry forward the losses. Legal heirs are entitled to set off and carry forward loss of the predecessor. Right? So section 78 talks about the change in the constitution and succession. In case of change in the constitution, the share of the retiring or deceased partner will not be allowed to be carried forward. In case of succession through the inheritance, then in that case, you can carry forward and set off the successor is allowed to carry forward and set off the loss, even if they constitute the firm. And in case succession otherwise than inheritance, it will not be allowed. Exception is the succession by the company, where there is a specific exemption for that. Are we clear? Now there is one small case which is there. So Supreme Court in Madhukant Mehta, case, this is the old decision, where the sole proprietor had expired, and after his death, The heirs succeeded the business as a partnership concern. The losses suffered by the sole proprietor were allowed to be set off by the partnership firm since the case falls under the exception. This is given in your module. Similarly, Supreme Court in another case in Saroj Agarwal, where there was a death of the partner, the legal heirs were admitted as partners in the partnership firm. The firm was not dissolved on the death of the partner. The partnership firm which suffered the losses had introduced the legal heirs of the deceased partner. This was held to be succession by inheritance, and the benefit of carry forward of loss was given to the reconstituted partnership firm. Are we clear? Whereas, in a very recent decision of Pramod Mittal, Delhi High Court disallowed the losses where the partnership firm was dissolved and taken over by the sole proprietary concern. So a partnership firm was dissolved and one of the individual partner took over the business of the firm as a sole proprietor. So in that case, the carry forward and set off of the loss by the sole proprietor was not allowed, because this was not a case of succession by inheritance, and it was a case of normal succession. And this was not even a case of succession of the firm by the company. So in that case, the losses were not allowed. Any questions, any doubt? Raja, in case of the partner-wise loss, we do not bifurcate in ITR. You're very right. But then you have to disallow the losses itself while computing it. So the section 78 will ask you to disallow the losses there and then. You cannot carry forward that portion of the loss of the retiring partner. Because if the assessment stage comes up, you would not put there in the ITR, but when the assessment will happen, they will disallow these losses. So you will have to do the disallowance at the time of the calculation of loss itself. That loss will lapse. You will not carry forward that loss. Clear, Raja? Any other questions? Any doubt? Okay. So shall we start with the deductions chapter? Let's start with it, because we still have some time left. So chapter 6A, deductions. Now there is amendment in section 80C, which I'll be covering tomorrow. But other than that, we can start with it. Okay. So first of all, chapter 6A, deductions. These are different from your exemptions. If you know, exemptions do not get included in the total income, whereas deductions are part of the income is included in the total income and then allowed as the deduction. Exemption under section 10A, the income does not form part of the total income, and therefore the heading of the chapter is also that the income do not form part of the total income. Are we clear? So there is a difference between the exemptions and the deductions. Clear? Now, in case of the exemptions, it is from 80A to 80U. All the deductions are covered. Now, in the case of deduction, there is section 80A which is there. Now, what does 80A provide? 80A talks about the computation of the deductions. It says that 80A provides that there shall be allowed from the gross total income the deductions. And the aggregate amount of deductions will not exceed the amount of the income. Meaning you cannot have deductions more than your income. Your deductions will be always restricted to your income, right? So 80A provides that no deduction shall be made in computing the total income which is exceeding the total income itself. Are we clear? Are we clear? Okay. Now, for the certain deductions which are based on the income, which are provided under chapter C, sorry, under the heading C, deduction in respect of certain income, they shall not be allowed unless they are claimed in the return of income filed under 139(1). So 10AA deductions or under any provisions of chapter 6A which are under the heading deduction in respect of certain income shall not be allowed as deduction unless the return of income has been filed before the due date of return of income under 139(1). So that is very, very important, right? So unless you file your return of income, you cannot claim the deductions under chapter 6A in respect of not 80C, 80D, not them, but in respect of the deductions which are in respect of income, which is under 80I, 80IA, 10AA, all of these deductions. Okay. Also, in case where there is transfer of the goods and services between the undertaking of the business which is claiming the deductions under 80IA, 10AA, all of that, then the transfer of goods or services will be at the market value. This is what we are going to see tomorrow when we will be doing those particular deductions. Clear? Any question till now? Okay. Then there is section 80AB, which also provides that for the purpose of calculation of deduction specified under the part C, which is deduction in respect of certain income, that shall be allowed or that shall be computed, the income shall be computed in accordance with the provision of the Act, which shall alone be regarded as of the deduction will be allowed only against that particular income, which is considered for the purpose of 80IE, 80IB, all of that. Okay. Next is that 80AC. So as I said, 80AC, 80A both provide that return of income before the due date, under section 139(1) is important or is mandatory, not important, is mandatory for claiming deduction under section 80IA, 80IB, all of that, which is deduction in respect of incomes. Deduction in respect of income. Are we clear? So this is what we are going to see tomorrow. Okay. Any other question? And how the deductions are to be computed? You have to compute against the gross total income. Gross total income means your income as per the specific heads of income, after including the clubbing of income of the other persons, then allowing the set off and carry forward of the losses, unabsorbed depreciation, all of that, and then only the deductions will be computed. Now coming to 80C, the first deduction, which is what we are going to discuss now. Under 80C, what are the investments or contributions which are eligible for deduction? Contribution in respect or premium paid in respect of LIC. So LIC, life insurance, premium paid. Life insurance premium paid. The premium paid for insurance of the life of the individual himself, spouse, or any child. Or in case of HUF for the member. HUF members. Right? So LIC premium paid. Any sum which is received under the life insurance policy. If you pay the premium, you are allowed the deduction. But when you get any sum which is received under the life insurance policy, including the sum allocated by way of bonus, that shall not be included in the total income. So that is exempt under 1010D. So sum received under LIC exempt under section 1010D. Are we clear? Sum exempt under section 1010D. Now, for the exemption under 1010D, the policies which are issued, right? For the exemption available under 1010D and for the deduction to be allowed under 1010D, there is certain condition. What is the condition? Where the life insurance is on the life of a person, where the life insurance is on the life of any person other than the person with the disability, then the condition is that the premium paid should be up to the 10% of the sum assured. Premium paid is restricted to 10% of sum assured. In case it is for the life of a person who is disabled, then the premium paid should be restricted to, for disabled, premium paid is restricted to 15% of sum assured. So this is the only condition. So any sum received which is in a case where the premium exceeds 10%, then in that particular case, the deduction will not be allowed, as well as the sum will be taxable under 1010D. Any sum which is received on the death of the person, for that case, the premium of 10% or 15% would not be applicable. So this condition not applicable in case sum received on death. So even in that case, if the sum assured is premium paid is more than 10% of the sum assured, but if it is received on death, then in that particular case, it will not be covered. Are we clear? So life insurance premium paid. In case it is for the death, then the 10% or 15% restriction will not be applicable. Then exemption is available or deduction is available even in case of unit linked insurance plan. So if the contribution is made in the unit linked insurance plan for the spouse himself or for the child, then in that case, for that also the exemption deduction is available. Contribution to unit link insurance plan. This we are going to cover tomorrow elaborately because there is an amendment over here. So it will take some time to explain. So that's why I'll be covering this in detail tomorrow for the ULIP. Clear? Any doubt? Also, in case where the sum is received under a keyman insurance policy, that sum is not exempt. Remember that. So here the exemption which is there under 1010D is for the LIC and not for keyman insurance policy. For keyman insurance policy, we have taxability under PGBP. In case it is for the employer, if it is for the employee, it is there under the salaries. In case it is for any person, it is there under the IFOS. Though Keyman insurance policy is defined as the life insurance policy taken for the life of another person who is employee or who is the employer or is connected in any manner in terms of the business of the person. It's a life insurance policy only. But that is not exempt. That is for the benefit of that key man, which is an important person for the business. Are we clear? Are we clear? Okay. So that is LIC. Premium paid in respect of a contract for deferred annuity, that is also allowed as deduction. Premium for contract of deferred annuity, that is also allowed. So premium paid to for deferred annuity on the life of an individual or spouse or child, then that is allowed as the deduction, provided it does not contain any provision for the exercise by the insured to receive any cash payment in lieu of the annuity. Right? Then any sum even deducted from the salary payable of a government employee for securing a deferred annuity, that is also considered as the deduction. That is also allowed as the deduction. Okay. Then contribution to the provident fund, whether statutory, public, or recognized. Contribution to the PF, SPF, RPF, or PPF. That is allowed as the deduction. But the maximum limit is 1,50,000, which is very clear, right? So that is also allowed as deduction. Or contribution to the superannuation fund. Contribution to the superannuation fund. Sum paid or deposited in Sukanya Samriddhi account. Contribution to Sukanya Samriddhi account for any girl child of the individual, then that is allowed. Subscription to NSC certificates. Subscription to National Savings Certificate, that is also allowed. And any interest on that is also exempt. Right? Then annuity plan, as I said, or pension funds set up by the mutual fund or UTI, that is allowed as deduction. Contribution to the tax saving FDs, that is allowed as deduction. Payment of tuition fees for 2 children, is allowed as deduction to any university, school, or other educational institution within India. This should not be outside India for the payment of fees within India. Then for the 2 children is allowed. Right? This shall not include any payment towards development fee or donation or normal tuition fee. This should be towards the university or school and not the private institutions. Okay. Repayment of housing loan. Repayment of principal portion of housing loan, stamp duty, registration charge. This is also allowed as deduction. Right? So any payment towards the cost of purchase or construction of a new residential house property is allowed. Right? Then investment in, as I said, the fixed deposit, which is tax saving, bonds issued by NABARD, notify bonds of NABARD, then deposit in senior citizen savings scheme, post office time deposit, post office deposit, right? Post office deposit, that is all allowed as the deduction under 80C. Are we clear? Now, if you withdraw the amounts or if you terminate the insurance contract, right? And in case you terminate any unit-linked insurance plan, or you transfer the house property before the expiry of the 5 years from the end of the financial year, right? Or you terminate any insurance policy within 2 years, then the deduction which is allowed to the assessee will not be allowed in respect of any sum paid, and a deduction will be deemed to be the income in which you sell the transfer the house or terminate the insurance policy. Or if you withdraw the amount from senior citizen savings scheme or post office deposit or tax saving FD within the 5 years, then the amounts of withdrawn will be deemed to be the income of the assessee. Clear? That will be chargeable to tax in that particular year. But if the amount is received on the death, then that amount would not be chargeable to tax. Clear? So, any termination of LIC or transfer of house within 5 years, termination of LIC within 2 years, or withdrawal from schemes in 5 years, deduction deemed as income, except in case of death. Clear? Now, the only one thing which is remaining is ULIP, which is what we are going to do tomorrow. Yes, premium can be in cash, Raja. Here, there is no restriction on the premium in cash. What if the conversion of company into firm? No, conversion of company into firm is not covered here. Jacob, in the case of 78, 78 is only for the partnership firm. Lab fee? No, lab fee is not covered. Only the tuition fees, which is towards the full-time fees. Clear? Any doubts? Okay. So we'll stop here and we will do it tomorrow, day after. I think it's on Monday. So on Monday, we will be completing this deduction chapter entirely. Okay. Any questions you want to ask before I close the session? Yes, here tax saving mutual funds are also covered. You can write it here. Tax saving mutual funds. That is also covered. Okay. Okay. So let's close for today. See you in the next class, but please revise. Thank you so much.